Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, February 6, 2023. It is 3:25 p.m. Eastern Time, so we have 35 minutes to go in the trading day, and not a lot new to report. But I just wanted to kind of do a brief update like I usually do. I'll start with the equity markets, hit on a few other things that some of the recently highlighted trade ideas and some new, at least one new one. And I just wanted to reiterate my thoughts. Near term, I think we were a little overdone. Still, short, going for that near term pullback off the top of the bounce target zone, plus price resistance and everything else we hit last week, and for all the reasons stated then. But as of now, and I've said this last week and maybe even the week before, I think at best case scenario, which is probably starting to be my most likely scenario, is that not only we're not going up much from here, that pretty much we've seen most or really all, I think, of the rally off the January lows for now, or the first quarter rally, the the technicals that were in place, the bullish divergences and the breakout of the trading ranges that came around Christmas, all that. I think that's all played out to its fullest extent. Again, that's just my take. So at best case scenario, and I think probably the most likely scenario, is we're looking at just a period for a while of some sideways and choppy trading. Worst case, which is still possibility, and I favor it more than this. I'm talking about when I say the next direction, the next tradable trend, I'm referring to at least a 10+% move. And so I still maintain I think the next 10+% is to the downside, and still the possibility that this whole thing here could be a false breakout in a bear market. False break above the downtrend lines and the 200-day moving averages, and we could have another leg down. But I think at this point in time, I think the most likely scenario is a grind around here, and pullback targets are going to be, you have the key levels I said to watch before, which are at this point in time the most important levels and also likely pullback targets. You have this primary uptrend line on QQQ right here that comes off the early January lows. You have the 200-day simple and exponential moving averages. They also come in with the primary downtrend line right there. So really back down to the bottom of that bounce target zone. And again, that's just I'm kind of in that near-term mode right now, and most likely if and as we get down there, I'll probably be covering those shorts, which I told you I might, when I put them on last week to fade the rally there, might consider holding those for the next leg down. I'll let you know, but at this point in time, I think we're just probably going to grind around. And the takeaway there is, if you are, let's just say you're relatively new to trading, or you're not very experienced, you haven't been doing this for decades, you haven't traded a bear market, and you're used to the easy money. We've caught, been, long or short at about every major inflection point so far in this bear market, whether hard shorts or scaling in, scaling out. And it's been, as I always say, I love bear markets. Not that I like doom and gloom, not that I like to know other people are suffering, because the majority do suffer through those. But to me, a bear market, the beauty is stocks tend to fall a lot faster than they rise. And also the counter trend rallies, the bear market rallies, are very powerful. They're little bull markets, if you will. They're double digits, each and every one of them so far. The Nasdaq rallied almost 20% this month, and it did it back here as well. And it did double digits back there. So what I'm trying to say is, don't expect that to be the case going forward. It is certainly possible we get another big move like that. I really, like I said, I put low odds that it's going to be to the upside from here. Again, from Friday's high, another 10% up before we go 10% down. But again, we may chop around. So the takeaway there is, if that's correct, and if you happen to agree with that, and I can sit here and talk for another hour on both fundamentals as to why that's, I believe it's the case, and both technicals. And again, it's just right now, it's my kind of leaning that way scenario. It's not a hard set, must happen. But the takeaway is, if it does happen, you're going to be frustrated as a swing or trend trader watching your account go up, down. And so again, if you think that's what's going to happen, you want to maybe take the quick profits, take profits on the early targets, or trade the bounces. I'll give you an example, what I'm talking about there. Like, I list multiple targets for a reason. So you take GDX, for example, and each each level is where reaction's likely. So, we hit T1 today. We're on there right now. T1 was through 30.09. We're at 30.14 after making a low today of 30.02. So that's that's a perfect hit. And a reaction is either a pause or consolidation. That we may bounce. Uh, this one is a swing trader. I think there was a lot of hot air, and the miners tend to move fast. I would lean towards a minor bounce, but if we get one and you're going to game it, and I'll have to study the charts. To be honest with you, I haven't I kind of sat down this morning, looked at a few things, got the post out to you, and I've been doing some other stuff because I didn't think there'd be a lot of trading ops today. I still have my shorts on the index, still short the miners and the metals, but that at most you have a big old gap there. So the way this works is if you want to play that, and again, I didn't prepare it for the video. I didn't zero in on the shorter term charts. I did glance them today, and I'm going to get to them in a second. I don't think we're going to get that. We may continue on down there, but I will say at T2, if gold and silver at support, and that's what today I didn't have either at good support, and that's why I'm not favoring much of a bounce off the miners. I think the miners, a lot of hot air, a lot of trap longs. There was a ton of FOMO in the miners, just like the stock market with Apple and all that. Remember, we wanted to own the FANGs down at the lows in the beginning of January, and that's where we're going long. And then the masses want to own them now. So where I'm going is that's what an active trader will do, is game bounces. And again, I was just kind of picking up on GDX because that hit target today, T1. But QQQ, play around, 60-minute chart, busy chart. There's your uptrend line again. There's some minor support here, but I think we'll probably come into that trend line, but it may not be a straight move down. It may kind of zigzag and chop its way down there again, which would be frustrating for typical swing traders. SPY, you can see the same comparable trend line, nice clean up trend line. So those are your minimum, if you will, minimum targets for the indexes. You could have a trend line like this. That one we just hit. There's the other trend line. This is just a different board, and there's the downtrend line coming in there. So, and then the whole apex of the triangle. So again, this is a near-term pullback target, not to be hit today, maybe not even this week, but probably in the coming weeks. And so we'll probably grind our way down there is my guess. And when I say my guess, you can hear from my voice, my convictions are high. I engage the market aggressively. When they're not high, I either don't trade, or I keep things light, or I go into active trading mode, or all of the above. Let me show you something on the futures today. One thing that stands out, this is NQ, the Nasdaq 100 futures. What I wanted to point out on this time frame, this is an hourly chart. We have some bullish PPO crossovers. We did this morning. The PPO is starting to turn down. We could get rejected, or it could turn up, but something that you have to respect. If you look at the PPO here, this is going back 1 month. This is what I call a low level bullish PPO crossover. Here's the zero line right there, right? And it's been a strong trend. Within there, the primary trend's been bullish, so most of the time you spent above the zero line. But when you've been under the zero line 4 times now. One, and here, and when you got under there, this is about as far down as you went. And so if you can see what happened there from this one indicator, it's a momentum indicator. You had a bullish cross, bullish cross, bullish cross, bullish cross. This time, again, the lines are sort of flattening out, but they are still crossed. That cross is in effect, and look what happened each time if you went long. Now the thing about it, again, this rally, we're overbought, we're long in the tooth, and that's why this one I don't think is going to have as much umph as these last 3. These last 3 were the corrections you wanted to buy in this rally. And at this point, sooner or later, you get to the point where everybody sees this, and that's right about the time it stops working. But with that being said, it is a low-level bullish cross, and it could cause us to drift up again, another pop-up. I don't think as much as these before we come down. And there's my same target. The trend line on the NQ is the same trend line. Here we go back right off the lows there. This is just a beautiful, time to be long. We're bullish divergences, everything else, and so we're walking our way up, getting long in the tooth, extended way too far away from this uptrend line, in my opinion. And so at minimum, I think that comes and gets visited soon. But it's a matter of, do we do that and then that? I mean, it's not a matter of. It's just my guess is we'll kind of maybe zigzag our way down there. So that's that. That's what the indexes look like. No reason to be crazy short when you have a bullish crossover on both. The 60-minute chart of NQ as well as ES. ES are the S&P 500 E-mini futures. NQ, of course, the NASDAQ 100. And I'm looking for my ES chart here. Bear with me. I've got it over here somewhere. There it is. And there it is. So this is also 1 month right there. There's our bullish crossover right there. Last time we had a low level there, and there in the last month. That was then, and now. If we cross back, it's going to be a whipsaw, and we very well could. And you know, I'd put close to equal odds we do, and then we come down and maybe put in a lower low and then get the bullish crossover. If we got that, see, this is one thing I like. I'd have a higher degree of confidence in covering shorts and going long. I'm going to just jump out to a 2-month. If we did this, if we went down here, both ES and NQ, here's our up. You have a primary trend line here. That's the primary, starts right there, the late December. Then this is the one early in the year. So let's just say we came to this one first, got down there, have a little rejection here, come down, then make a bullish crossover. That to me is a great time to, or a better time, if you will, to cover some swing short positions. You know, if you shorted Friday and then reverse long, but probably gonna go do something like that along those lines. All right, let's cover a couple other things. I wanted to point out crude oil. Crude oil USO hit the uptrend line perfectly today. It's the same uptrend line I've shared with you for months, many months now on my daily chart. Let me populate the lines. There it is. I'm talking about the uptrend line that comes off the early 2021 lows right here. This one, we have lots of reactions. So crude, you know, so far has bounced and probably will play out a little bit more. That's one. You know, that's a cluster. I'm showing you not just a single candle, a cluster of candles that tagged it. Distinct reactions: 2, 3, 4, 5, 6, and now 7. PPO is right on the zero line. The zero line often delineates bullish and bearish trends. When you're above the zero line, the PPO is above, and always look at the white line there, the 9 EMA or the signal line, because that's the last of the two to cross. So once you're above, like you broke above it here, the line then, the zero line then acts as support often on pullbacks, and support. Finally, it broke. That proved to be a whipsaw. And if you just only traded this indicator, now I like to use it in conjunction with other things, but even this would have got you in. You would have milked almost all of the rally in USO and gotten out of a good part of the corrections. You would have gotten out. Let's say that you said, okay, PPO crossed over there, bearish under the zero line, up, but it's back in. I'm going to get back in my long. And then, you know, you got whipsawed out there. But again, you caught the bulk of the trend. You were long throughout here, and then there you shorted again. You stayed faithful to the signal, let's just say, and you know, you sidestepped the biggest drop in crude oil in years right there, and you had one whipsaw, got you out, but then you were short again. Now, point is, we're above it. And the only thing I'm going to say to this is that start to give it a little, definitely a little, and that's relatively speaking, a little less weighting, or pay it a little less attention when price starts to compress. Remember, the big picture here on USO is this and this. There's our primary downtrend line, the primary downtrend line off the highs right there that came earlier back in May or June of 2022, and there's our uptrend line that forms a symmetrical triangle pattern. And so prices are starting to compress. Volatility is going down. The moves are getting smaller and smaller. It's likely to break one way or the other soon, and that next break above or below the triangle will determine the next tradable trend. But what I'm going to say is, or what I am saying is that when prices start to compress and the MACD starts to flatten out and hovers around the zero line too much, you tend to get more whipsaws than when you have these clean breaks and the clean moves above, you know, when you have these more powerful trends. But with that being said, we are above it, and maybe this is a new crossover, and again, we're at support and the PPO signal line is still there. And then on the 60-minute chart, This is a 15-minute chart of CL crude futures, and we had nice positive divergence today at the lows. You had RSI has been diverging from this point right here, and the PPO has been diverging from this point here. So I don't have a hard target. I'm looking for 75.62, most likely minimum. Maybe we'll get a downtrend line forming there as well. And just wanted to update that. So that's one that again, watch that. I think it plays into my whole vicious cycle or negative feedback loop with commodities in the stock market. So stock market's been rallying. Stock market's been rallying on primarily on expectations that the Fed would is going to soften, but those expectations got somewhat squashed last week. But the market's been ignoring that. So right now, it's the thing is who's right, the stock market or the Fed? Fed says they're going to keep pressing the rates upward, and the market thinks otherwise. And so again, that's where the cross currents fundamentally, I think the upside's probably limited in the near term. So there it is. There's crude oil, and it's partner in crime, although they don't always trade together, and quite often they don't. So just because they both come out of the ground together doesn't mean they always trade together. This is just a powder keg waiting for that spark to ignite it, and that's this very super well-defined, super clean, testing it just about every day downtrend line. Back here I said, look, we need to see, would help to see, will be a bullish crossover on the PPO, just like we had right there. After that strong, powerful downtrend, you got it right there, boom, and that was with the breakout. So they'll come together. The PPOs tried to cross over but never did. It didn't even kiss. Came very close but got rejected. If I stretch, you can see. So it's starting to turn up again, and it's buried. I mean, by buried, it's down very low, as is the RSI. You can see the RSI extreme oversold conditions. And so again, pop. You'll get, technically speaking, I don't care. I don't want to hear about the glut of natural gas right now and demand down and seasonality, and it's warming up. This will be a technically induced rally, and so I've been highlighting it and highlighting it and highlighting it. We just need that boom, that catalyst, and still looks like, even though it looked like it was coming any day back here, it still looks like it's coming any day. So watch for the breakout, watch for the bullish PPO crossover for confirmation, and then I don't really have a target until all the way up here, about 1181. There's just not a lot of resistance on the daily chart. That'd be about a 40% pop if and when hit. So let's look at the other things. Commodities still look, the RR looks better to me than the stock market. That's the risk reward ratio. Wheat, you have this. I can do a benefit of the doubt trend line. Here, I'll show you a clean board and I'll tell you what I'm talking. So here you can see there's two little candles that I kind of excluded there. So I'm going to pull this up now and then hit the top of these two candles. So now I have one, the initial, two, three distinct reactions, and that puts us, I'm going to get right on top of that candle. Pull this line down a little. I'm just fine tuning the trend line, and pull that down just a hair. Comes in 1, 2, 3. Pull this up just a hair. You see what I'm doing. I'm just retrofitting this because we broke out, but it's not been impulsive. So now I think this is the better fit. Either way, we're pushing there. In either way, this is a big bullish falling wedge with positive divergences that have been building for a while, and still like it. It's not running yet, but I think it's going to run soon, and I think we'll see that kind of reinflation trade start to pick up sometime here in the first quarter. It's in the next couple months. And commodities, I'm selective. I told you we were in lumber. We caught a 20% run. I shared that as a trade idea, and then I told you last week I took profits here because I suspected pullback. Said, look, when you get, was it 20 or yeah, it was 20, I believe, percent. And then I told you we had the divergence, and that's played out. So if you got out of there, you sidestepped a give back so far of about 10%. And that's what, again, what active trading is about, and things like that are one of many things that go into my analysis when we're not looking for anything to break away and run away right now. So lumber longer term, the chart was still constructive. We had a big breakout back recently on the daily, but again, I'm kind of in this hit and run mode, more active swing trading. Again, what I'm trying to say is 2022 was, at least for me, a great year for trading, very profitable year, a very easy year. 2023 might not be so easy, but we'll see. I always say the charts are dynamic, and so is my analysis. If we start moving down and taking out the 200s, falling back below there, and start moving impulsively and smashing through one support level after another, maybe we are going to get another flush out. If I'm wrong and we start going up higher and we start busting through resistance levels that, in my opinion, should be sold into, if we are at where I think we are in the economic cycle and in the stock market cycle, such as, we'll go back to my original board of QQQ, that purple box, which is the uppermost bounce target zone, and that would be about 333 on QQQ, then I might be looking for something more on the upside. Okay, pardon me, I had a phone call there I had to take real quick. So, yeah, so, and if that happens, that happens. We're not extreme overbought. We're not. Remember this line down here on my original board, about 80.37 on the RSI. That is I've had that forever and a day from the last bull market. That's overbought in a bull market. In other words, 70, as I've said recently, in a bear market, you get 70 on the RSI. That's usually when you want to exit the longs on your bear market rally and get back in short, because that's usually all it is a fleeting little pop of the 70 level tag of, or just close to it, or a hair above it. But in a bull market, you go up. That's not overbought. I'm sorry. In a bull market in QQQ with these tech stocks, it's really a push up to about the 80 level that is overbought. So you want to hold there. So if you are a bull right now and you think that's, we're in a new bull market and that was the end of a bear market, then you can buy pullbacks aggressively, any pullbacks to support. And that's what I do in these videos. I lay out levels that are key levels. I'm going to share what my thoughts are and what my positioning is, right or wrong. But at the end of the day, you might take a different view than me, and therefore the same levels that I might be looking to, let's say, short, like a trend line that once it breaks, you might be looking to buy a pullback. Because that's where my skill sets tend to lie, I think, is identifying key support and resistance levels that are likely to produce reactions, or likely battlegrounds for bulls and bears. If the bulls are in control, remain in control, then they're going to buy, should come in pretty hard at the uptrend lines here. And then if not there, of course, the 200-day moving averages on a back test, things like that. Okay, just a couple more. And remember, also, if it is going to be a more challenging environment for swing traders, I've put out in the last couple months here more individual trade ideas than I have in a while. In a fast-moving bull bear market, I'll always throw out the cryptos and the Bitcoin and individual stocks that stand out. But it's easy to trade the indexes and move in and out real quick and watch those, especially when things are moving very fast. Because in a slower moving market, it's easier for me to monitor a portfolio of, or a basket or watch lists of 20, 30 individual stocks plus every index. Because you know me, I don't look at just one index. I look at QQQ, SPY, small caps, sometimes the mid caps, sometimes the Dow. I look at commodities. I look at bonds, gold, you name it. And I'm always watching these things, or I'm trying to, on my radar. And so therefore, if things kind of slow down, we go into trading range, and where I think we're going in there, and I think there's more opportunity in trading individual stocks, because that's where, again, the whole theme of this video is, you trade the S&P 500, you're buying and selling, whether you're a bull or bear, long or short. You go long the S&P or short, you're going long the most most bullish and the most bearish of the 11 sectors, as well as the most bullish and the most bearish of the 500 stocks. What I'm trying to say is, at any point in time, the S&P 500 is so diversified, in utilities have nothing to do with tech stocks. In fact, they tend to move almost not inversely, but quite often they do. And so therefore that dilutes your return. So in a sideways market, you're just really going to get grind up and go nowhere. And the takeaway from that too is, if you are a swing trader and you're patient, you say, okay, I get that. Maybe we will grind around, maybe not. but I'm going to position long or I'm going to position short for the next leg down, you might want to move into non-leveraged ETFs, either short SPY or buy, I think it's RSP, the inverse, if I'm not mistaken, of the S&P 500 without leverage. Yeah, no, that's the equal weight. That's SH is the non-leverage because of the decay. Leverage ETFs, I write about it in the FAQ page. You can find that under resources on the website, and it tells how the math works. Leverage ETFs actually, they're, most people talk, most of the articles I've seen about them are very negative, and they shouldn't even be allowed. They do great in what I call mostly unidirectional trends, when the underlying security index or commodity or ETF or whatever sector, whatever you're tracking, is going mostly up or mostly down. They tend to do better than their leverage factor. In other words, you can do better than twice the S&P or twice the gold mining stocks if you're into dust or nugget in one of their strong trends. But you get the decay happens when you do grind around. So keep that in mind, and then put that into your trading plan. And the worst of the worst culprits are the most volatile sectors, like the miners, for example, dust, nugget, natural gas. If you want to be patient and sit and hold a position in natural gas, I like the futures, but if you're an ETF trader, at least go with UNG. It doesn't have leverage. If you go with oil or cold, and you get in this trading range like this, they don't do well. But in a trading range like this, I'm sorry, a directional trend like that, or this, and that's what natural gas usually is doing. It's things usually full throttle up or full throttle down, little corrections. But every now and then it'll consolidate for a while, chop around, and so just kind of recognize what kind of trend you're in. This next trend, we get a buy signal, at least initially, should be about a lot of short covering, but anything's possible. You could grind around. So again, the safe call is to use the non-leveraged, and especially from the feedback I got from the site, I'm going to have to start stamping certain trades like UNG. I try to do my best and explain how volatile it is. Use the position size calculator I created on the site. That's also under the resources tab. Yeah, it's take your position size down as well as the other big thing. Because know what you're trading. UNG, natural gas, I should say, lumber futures, a stock like Tesla. These things move up and down much more, easily double digits in a single day, much more than a regular stock or sector or the broad market. All right, so just a quick update on the individual trades. I threw out a bunch. We're looking at the Dow recently. When I was expecting outperformance on the Nasdaq stocks, big tech, and the Dow did. You can still see, especially since the beginning of the year. Look, there's January right here. Started the year right here, and we're up from where we started the year about 1.4%. So that was that was certainly what played out. You can see what right here. There's the first trading day of the Nasdaq right there, and to the recent highs, we're up almost 19%. We're still up about 16% year to date. So sorry, I hit the wrong thing there. That wasn't QQQ. This is QQQ. There's the third right here, that candle. We closed right there on the third. And that was about, same thing, about 18% rally right there. Oh yeah, individual names. So going back to the Dow, like I said, I threw out some individual shorts. A lot of healthcare companies, things that had led the way, and those we've actually profited on. If you took any of those on the short side, like UNH, that was our sell signal there on the breakdown, still walking its way lower. JP Morgan still setting up, hasn't done. Walmart's starting to crack that secondary trend line, but really too close. I had a little pierce before, but I do favor stocks like this on the short side. Might be a slow grind down. I'm trying to recall the ones. Merck I laid out here. That one was sell signal breakdown there, and it just hit that first target. A lot of these that I did lay out earlier, Coca-Cola, KO hit the first target. Disney I wanted to share. This one I shared as a long trade idea recently. because it was, although it was a S&P and Dow component, it was at a 52-week or multi-year low instead of a multi-year high like the others. And so we milked that, and I think it's a good short right now because you have this uptrend line. I think it's, certainly met my first target, hit the trend lines, the 200-day moving averages, and then this price resistance. It may want to work its way up here if the market has a good year, but I think in the near term, you can see it's just triggered a sell signal today. So this is an active short trade right now, or an objective short entry, whatever you want to call it, and get a pullback and probably back test this trend line right there. So it's not a big monster trade. Longer term chart still bullish, but maybe a quick 6% or so pullback to the uptrend line and that blue line, which is a 200-day simple moving average. Maybe I'm going to move this up. That was the first target there, that 95. I'm going to move that to right there, 101. Let's just keep it very simple. 101's a swing target, pullback target for that. And you also look at this PPO, high level bearish PPO crossover in the works. Hasn't happened yet, but we're about to get one. The last time we had a high level bearish PPO crossover was right here, and you can see what Disney did from there. All right, so that's about it. I think I told you I'd look at gold and silver, and I didn't do that. Silver, like I said, this is just an hourly chart. Silver is probably going to have a little bit more downside. You can see it's starting to set up some divergence on the 60-minute chart, but from the look of the PPO, might need one more thrust down. Yeah, I mean, technically you have the positive divergence now. I don't have really great support there on silver, at least not on the 60-minute chart. I'll look at the ETF in a second. Let me look at gold for you real quick. And gold, same thing. You can see this is a 60-minute chart. We had, oops, not the right line tool. There's our line tool. We had the sell signal, the breakdown there. We've been walking our way lower, and I'm still looking to move to at least this level here. That comes in that support zone, target zone. The top of it comes in around 1853. If we get there soon, we're going to have some nice divergence, and that's where you might want to cover and or reverse a gold short for a bounce. Same thing with GDX. GDX is at the first target, so it may bounce there. Probably will bounce there, that's my guess. But when I jump over to the chart of GLD, we clearly took out the primary uptrend line right here, and that coincided with the breakdown on the futures. And like I said, it's kind of a no man's land. There's not really great support, so probably I don't think the correction's over. To me, it's a matter of, we're going to bounce. Everybody, it's FOMO. Nobody wanted to buy gold here, but they all wanted to buy it recently, and so there are a lot of people trapped in, and they're going to be that usually get that initial wave of buyers that felt they missed out and don't know technicals and want to buy this, but I wouldn't try to game this bounce. I would just sit tight for now. I think there's more downside on gold to come, and silver. Here's a potential trend line that may come into play. Oh, we hit it. See, I had that trend line there. I just extended it, so that's why we're having that reaction. But again, not great support, and I'm going to show the euro, and then I'll wrap this video up. There's silver. Silver had support here at 2060. That was one of the targets I gave you on SLV, the ETF, and it's pretty good support. We're a hair below it now, but I suspect we're probably going to continue to work our way down to that 1982, and possibly, and this would be a great reload point if we get all the way down to about that 1911-ish level. There's the closing bell. Let me just give you the Euro USD, and that's the really whole major reason for looking for the short and the pullback on the miners and the metals lately. We broke down. There was our breakdown the other day. We're just fresh off the breakdown of this bearish rising wedge pattern, and I've maintained for weeks now, not months, before we even broke down, that this is my target, and it still is. Somebody asked today, that's why I wanted to update this. You have the primary downtrend line, which comes all the way back. I know this is a busy chart, just follow the blue lines as I draw them. Primary downtrend line, and this is the primary uptrend line off the lows, divergent high, breakdown. I think we work our way down here, possibly all the way for a back test of the trend line, the downtrend line, that is. So really it's a pullback target zone, and as long as, if I'm correct, and that's where the euro is going, that's going to continue to put pressure on gold and silver. So we get down here, that's when I'll be more interested in getting back into the long positions for gold and silver for the next leg up. But coming off that big divergent high, and as overbought as we were on the euro US dollar. I think there's still more downside to come. And remember, that's just the euro US dollar pair. It's just the dollar index in reverse. This is the US dollar index itself here. US DOLR is what TC 2000 uses. And you had that bullish falling wedge right there and a breakout right there recently. Back testing now, but I think we'll come on up and probably rally at least up here to that 12,968 level, possibly a little more. All right, I'm going to wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great